Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
And so with those observations in mind, we're going to step back and say, okay, what options are going to have the highest probability of expiring worthless? So when we look at constructing this strategy, what I've done is I've just yesterday, with yesterday's values, I constructed a bear call spread on the YUK. And what I look to do, as you can see here, is I look to create a credit in my account by selling 10 94 strike call options. So what I believe is that the YUK between now and the third Friday of June is going to be below the 94 level. Now, I collected $1.22 into my account. And remember, I sold 10 of them. If I sold one, it'd be $122. If I sold 10, it's going to be $1,220. Now, what that means, of course, is that we sold a near-the-money call option for a credit. Why did we try to sell the option contract that is closer to the money? Well, remember, we collect a higher premium for options that are near to the money. But if we, and the way that I look to construct my credit spreads is that if I can collect an attractive premium further out of the money, it's going to be less, but if I'm comfortable with that percentage rate of return based on my risk, then what I'm going to do is I'm going to go further out of the money, because the further out of the money I go, yes, I'm collecting less premium, but I have a higher probability of that option contract expiring worthless. So just when we talk about the whole idea of measuring risk and you know, the greater reward we're looking to fulfill, the more risk we're going to have to take. Well, same goes with your strike price selection. If we want a higher premium, if we want to net out a greater percentage rate of return on our credit spread, ultimately we're going to go with an at-the-money to slightly out-of-the-money option contract. If we want to take some of that risk off the table, if we believe that maybe, you know, there's, because of market volatility, prime example, that there's more risk in the market at this 94 level, then maybe we want to go out and we want to sell the 95 or sell the 96, collect less premium, but have a higher probability of those options expiring worthless. In any event, what we've done here is we've sold a near-the-money call option for a credit. That money is deposited in our account right away. Ultimately, in order to cap our risk exposure, we buy a further out-of-the-money call. This cost is deducted from the credit that we've received. So when we move forward to the actual profit and loss scenario, you'll see that the maximum profit that we're going to make is determined by taking the short call option credit and subtracting the long call debit. So what this results in is a credit of $280. Now, we have to understand as well that there is a break-even point, because we are keeping the time component to all of this. No matter where this underlying pair value goes, even if it goes to 97, remember that everything that we're using here, all of the options that we're using to construct this strategy, are made up entirely of time premium. And regardless of how much intrinsic value is generated between now and expiration, all of that time value is gone, meaning that $280 or 28 cents is ours to keep. So when we look to factor in what our break-even point is, we have to understand that in the case of the bear call spread, our break-even is going to be the sold strike price, which is 94, plus the credit that we've kept. So in other words, we're not going to start losing any money until the YUK is trading above 94.28. All right? Now, obviously, as we begin to break above that level, you can see that our risk is capped at 95 $720, where of course we've taken the spread differential, the strike spread, which is 1 point. You can see 94.95 is 1 point. We multiply that by 1,000. We subtract that $280. We have our maximum risk exposure. Now, the question always comes up is that there's a great one, the greater the risk, the greater reward, the greater probability of keeping the money seems backward, but it seems to work. And the idea is it does. We're always looking to collect as much of the premium as we can, but we have to remember that the options market is all about probabilities, and these options are priced based on these probabilities. So we have to understand that when we're looking at trying to determine the probabilities of options expiring, right, we want to think like that market maker, in the sense that the further out of the money, the less chance that market maker is going to have to fulfill their obligations in taking on the opposite trade. So what they're suggesting is that there is a higher probability of those options expiring worthless. So again, we give up some of the percentage rate of return, but we have a higher probability of capturing that credit. Now, again, with this type of strategy, we have a percentage rate of return that is, of course, less than what our risk is. But what you need to understand is that we assume that type of risk-reward scenario all the time as a buyer of a stock. In other words, many people will put up $100 per share to make $2 per share. Or many people will, in the case, because we've talked about being an option writer as an alternative, an option writer will essentially assume the entire risk on the underlying security to receive nothing more than the premium that they've collected. So while we have to address the fact that, yes, there is a smaller profit potential for the risk that we're taking on, the objective is to identify that risk, so that in the event that there's a crazy market anomaly that takes place, that we can sit back and say, okay, let's let the dust settle. We know what the maximum risk exposure was. Let's see how this all plays out, rather than being scrambling to cover our positions, or having our, the brokers scrambling to cover them for us. We now have a limited and identifiable risk exposure. In this scenario, we cannot lose, no matter how high the YUK goes, any more than our $720. Now, that's a pretty decent rate of return for 1 month. The idea is that, again, we could go to a higher strike price, collect a little less of a return, but be able to capture or be able to enjoy a higher probability that the option is going to expire worthless. Now, remember that we're going to have a margin requirement for the spread strategy as well. When we're selling an option naked, our margin requirement is going to be essentially whatever our brokers are allowing us. It may be 3-to-1, it may be whatever it is, but recognize that we're going to have to put up a certain amount of capital in order to hold that short call option or that short put option, because we have a specific obligation to buy, to either buy the security from somebody or go out into the market and buy to cover our obligations with the call option. But here, our margin requirement is capped at the spread differential between the strike prices minus our credit. So in this particular scenario, the most that we have to come up with is $720, whereas there's just an observation with respect to if we're using, say, a company where there's a higher spread differential. The idea is that the smaller the spread, the less capital we're going to have to put up to participate. The wider out the spread, of course, the more capital it's going to take from our margin requirement, but we have an identifiable margin requirement. We have an identifiable risk exposure no matter where the underlying goes, in this case the YUK, no matter how high it goes. We do not have to risk any more than, in this scenario, that $720.
Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.